Hello everyone, this is Nick. Welcome back to the second video of our series breaking down Benjamin Graham's classic book, The Intelligent Investor, which Warren Buffett calls the best investing book ever written. Today we are diving into chapter 1, which Graham titled Investment versus Speculation. This is arguably one of the most important chapters in the entire book because it gives us the crucial definition that separates serious investors from everyone else and lays out the three key criteria you must follow for every single investment you make. Master this chapter and you will be ahead of 99% of people in the market. Stay with me until the end because here's the thing. Successful investing requires patience. If you don't have the patience to watch a 30-minute video about investing, you are proving you lack the discipline needed for long-term success. The ability to sit through this video is the exact same skill you'll need to stay calm during market crashes and hold winning investments for years. If you are serious about mastering this book and building the right investor mindset, hit the subscribe button and click the bell icon so you don't miss any future episodes. Let's start with Graham's definition of an investment. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. This is one of the most important sentences you will ever read about money, so let me break it down. According to Graham, just buying stocks doesn't make you an investor, it makes you a speculator. To be a true investor, you need three things working together. First, thorough analysis. But what exactly does analysis mean? In Graham's earlier work, Security Analysis, he defines it perfectly. Analysis connotes the careful study of available facts with the attempt to draw conclusions, therefore based on established principles and sound logic. It is part of the scientific method. This applies to any investment, whether you are buying stocks, bonds, real estate, or even a business. If you are investing in stocks, analysis doesn't mean staring at price charts or looking at historical stock prices. That tells you nothing about what the company is actually worth. Real analysis means studying the company itself, their financial statements, their business model, their competitive advantages, their management, and their industry trends. Second, safety of principal. Your analysis must show that your money will be reasonably safe. You are not looking for guarantees, but you need solid evidence that you are unlikely to lose your initial investment. Third, adequate return. You should expect a reasonable profit that justifies the time and risk involved. If any of these three elements is missing, you are not investing, you are speculating. Here is your new framework. Whenever an investment opportunity comes up, ask yourself these three questions. Am I doing the thorough analysis required? Does my analysis prove that my capital is reasonably safe? Can I expect an adequate return? If you answer no to any of these questions, you are speculating, not investing. Graham points out that the word investor gets thrown around carelessly. The newspaper employed the word investor in these instances because, in the easy language of Wall Street, everyone who buys or sells a security has become an investor, regardless of what he buys or for what purpose, or at what price, or whether for cash or on margin. Think about this. Warren Buffett is called an investor, arguably the greatest investor of all time. But YouTube is also full of Bitcoin investors and GameStop investors. What do these people have in common with Warren Buffett? Absolutely nothing. Don't be fooled by labels. Now that you know Graham's definition, you can clearly distinguish between real investors and speculators, and this understanding alone will save you from countless expensive mistakes. Now, here is something important. Graham isn't saying speculation is evil. He writes, outright speculation is neither illegal, immoral, nor, for most people, fattening to the pocketbook. More than that, some speculation is necessary and unavoidable. For in many common stock situations, there are substantial possibilities of both profit and loss, and the risks therein must be assumed by someone. There is intelligent speculation as there is intelligent investing. So speculation isn't the problem, unintelligent speculation is. Graham identifies three ways people speculate unintelligently. First, speculating when you think you are investing. This was my biggest mistake when I started out. I bought stocks without doing any real analysis, convinced I was investing. I wasn't. I was gambling and calling it something else. Second, speculating seriously when you lack the proper knowledge and skill. Look, speculation can be exciting and fun, but if you don't have the skills for it, treat it like entertainment, not a serious wealth-building strategy. Third, risking money in speculation that you can't afford to lose. This should be obvious, but it is worth stating clearly. Never speculate with money you need for rent, groceries, or emergencies. Graham makes another crucial point about margin trading. In our conservative view, every non-professional who operates on margin should recognize that he is ipso facto speculating, and it is his broker's duty so to advise him. For newcomers, here is what margin trading means. When you add money to your brokerage account, they offer you additional borrowed money to trade with. For example, deposit $10,000 and your broker might let you buy $10,000 worth of stocks by lending you the extra $10,000. But here is what they don't emphasize. You are paying interest on that borrowed money every single day, just like any other loan. So, even if your stock doesn't move, you are losing money to the interest charges. And while margin can double your potential profits, it also doubles your potential losses. If your stock drops 10% instead of losing $1,000 on your own money, you lose $2,000, which represents a 20% loss on your original investment. Even worse, if your losses get too big, the broker can force you to sell your stocks immediately to pay back the loan, often at the worst possible time when prices are low. This is why Graham says anyone trading on margin is automatically speculating, not investing. You are adding unnecessary risk, complexity, and ongoing costs to what should be a careful, methodical process. Graham also warned us, and everyone who buys also called hot common stock issue or make a purchase in any way similar thereto is either speculator or gambling. This is Graham calling out the dangerous trap of chasing hot stocks. You know, the ones everyone is buzzing about on social media, the next big thing that's going to make everyone rich overnight. Think GameStop, AMC, or any trading cryptocurrency. When you are buying based on hype instead of analysis, you are not investing, you are gambling. By the time a stock is hot, the easy money has usually already been made, and you are often buying at inflated prices from people cashing out their gains. So the next time you hear about a hot stock opportunity, ask yourself, am I buying this because of careful analysis or because everyone else is talking about it? If it is the latter, you are speculating. But speculation can be fun if you do it the right way. See what Graham says. Speculation is always fascinating and it can be a lot of fun while you are ahead of the game. If you want to try your luck at it, put aside a portion, the smaller the better, of your capital in a separate fund for this purpose. Never add more money to this account just because the market has gone up and profits are rolling in. That's the time to think of taking money out of your speculative fund. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Graham is giving us a smart framework here. If you want to speculate, fine, but do it intelligently. Set aside a small amount of money you can afford to lose completely, and never touch your real investment money for speculation. Most importantly, keep them completely separate. Different accounts, different mindset. When your speculative bets start paying off, that's actually when you should be taking money out, not adding more. This separation protects your serious wealth building from your entertainment budget. Then Graham continues by explaining again what a defensive investor is and what outcome he must expect from the market. We have already defined the defensive investor as one interested chiefly in safety, plus freedom from bother. This is Graham's template for most people. The defensive investor isn't trying to beat the market or find the next Amazon. They want two simple things: to keep their money safe and to not spend all their time worrying about investments. If this sounds like you, Graham has specific strategies designed exactly for this approach. The defensive investor accepts average returns in exchange for peace of mind and simplicity. So what exactly should a defensive investor do? Graham has very specific recommendations. He suggests a simple portfolio split between stocks and bonds, shifting the allocation based on the market conditions. When stocks get expensive, move more towards bonds. When they get cheap, shift back to stocks. It is beautifully simple, but requires discipline. And here's something else Graham surfaces: the link between bonds and stocks. Here is a simple example to understand this relationship. Let's say government bonds are paying 2% interest. That's safe, guaranteed money with virtually no risk. Now, if you can buy a solid company's stock that is earning 6% on your investment through dividends and growth, that stock looks attractive compared to the safe 2% bond. But if bond rates jump to 8% guaranteed, suddenly that same risky stock earning 6% doesn't look so good anymore. Why take the risk when you can get 8% safely? We saw this play out dramatically in the early 80s, when the government bonds were paying over 15% annually. The stock market struggled because why would anyone buy risky stocks when you could get 15% guaranteed? Conversely, in 2020-2021, where bonds were paying close to 0%, investors flooded into stocks because there was nowhere else to get decent returns. This is why bond rates and stock prices often move in opposite directions. When safe, guaranteed returns go up, risky investments like stocks become less attractive. Let's go back to the book. At page 24, Graham writes, "This is just another of an endless series of experiences over time that have demonstrated that the future of security prices is never predictable. This is crucial. No one can predict stock prices or bond yields." Also, Jason Zweig adds, "Read Graham's sentence again and note what this greatest of investing expert is saying. The future of security prices is never predictable." And as you read ahead in the book, notice how everything else Graham tells you is designed to help you grapple with that truth. Since you cannot predict the behavior of the markets, you must learn how to predict and control your own behavior. This is the entire foundation of Graham's philosophy. He is not teaching you how to predict what the market will do. He is teaching you how to control what you do regardless of what the market does. The defensive investor strategy, the three criteria for investment, the separation of speculation from investing, it is all designed to help you make rational decisions in an unpredictable world. And this applies to enterprising investors too. Even though they are doing more analysis and trying to beat the market, they are not predicting future prices. They are finding companies trading below their intrinsic value and waiting for the market to eventually recognize that value. They can't predict when that will happen. It might take months or years, but they can control their own behavior by sticking to their analysis and being patient. Now, Graham goes on to tell us what result an aggressive investor should expect. But first, let me clarify what Graham means by aggressive investor, because it is not what most people think. Graham uses aggressive and enterprising interchangeably. An aggressive investor isn't someone who takes big risks. They still follow the same three criteria: thorough analysis, safety of principal, and adequate return. The aggressive investor is simply someone willing to put in significantly more time and effort to potentially earn higher returns. They are aggressive in their research, not their risk-taking, treating investing like a serious, part-time job rather than gambling with risky investments. That's probably you because you are watching this video. You are willing to spend time learning about investing principles instead of just throwing money at whatever is trending on social media. So, what results do the aggressive investor expect to gain? Our enterprising security buyer, of course, will desire and expect to attain better overall results than his defensive or passive companion. But first, he must make sure that his results will not be worse. It is no difficult trick to bring a great deal of energy, study, and native ability into Wall Street and to end up with losses instead of profits. This is Graham's crucial warning. Just because you are willing to work harder doesn't guarantee better results. In fact, many smart, hardworking people actually do worse than the simple defensive approach because they outsmart themselves. He continues. Thus, it is most essential that the enterprising investor start with a clear conception as to which courses of action offer reasonable chances of success and which do not. In other words, before you dive into investing, you need to know what actually works and what doesn't. Graham starts by telling us what does not work, and if we follow Charlie Munger's principle of inversion and avoid these things, we are much more likely to have positive results. So here is what does not work according to Graham. Trading in the market. This usually means buying stocks when the market has been advancing and selling them after it has turned downward. The stocks selected are likely to be among those which have been behaving better than the market average. A small number of professionals frequently engage in short selling. Let me clarify what Graham means by trading. He's not talking about day trading or buying and selling within hours or days. He's referring to what we might call momentum investing, buying stocks that have been performing well over weeks or months, then selling them when the trend reverses. This approach involves picking stocks that are outperforming the market and riding that momentum, hoping to sell before the trend changes. Remember Graham's definition of analysis. This isn't analysis, it's following the crowd and hoping you can get out before everyone else does. This turns you into a speculator because you are gambling on short-term price movements instead of doing thorough fundamental analysis. And remember, Graham is warning against this relatively slower form of trading. I wonder what his thoughts would have been if he could see today's day trading madness and the apps that promote that behavior. Graham also said that short selling doesn't work for most people. While the concept sounds simple, borrow shares, sell them, buy them back cheaper, the reality is brutal. Your potential losses are unlimited because there is no ceiling on how high a stock price can go. You can lose many times your initial investment. Plus, you are fighting against the long-term upward trend of the market. Even if you are right about a company having problems, you can be wrong about the timing, and the market can stay irrational longer than you can stay solvent. Short selling requires perfect timing, which brings us back to Graham's fundamental point. The future of security prices is never predictable. So Graham's first rule for enterprising investors is simple. Avoid trying to time the market through trading, whether you are going long or short. Here is another strategy that Graham says it does not work. Short-term selectivity. This means buying stocks of companies which are reporting or expected to report increased earnings, or for which some other favorable development is anticipated. This sounds reasonable at first. Buy companies with good news, right? But here's the problem. By the time earnings growth or positive developments become public knowledge, the stock price has usually already moved up to reflect that information. You are essentially buying stocks after the good news is out, which means you are paying a premium for information everyone already knows. The market is incredibly efficient at pricing in expected developments. So when a company reports better than expected earnings, you are often buying at the peak excitement rather than getting a bargain. And here is another strategy that does not work. long-term selectivity. Here, the usual emphasis is on an excellent record of past growth, which is considered likely to continue in the future. In some cases, also, the investor may choose companies which have not yet shown impressive results, but are expected to establish a high earning power later. This is what we call growth investing today, buying companies because they have been growing fast and you expect that growth to continue, or buying companies that aren't profitable yet but might be in the future. Here is why Graham says this doesn't work. First, you are paying premium prices for that growth expectation. Everyone else sees the same growth story, so the stock price already reflects those high expectations. You need everything to go perfectly just to break even. Second, past growth doesn't guarantee future growth. Companies face competition, market saturation, and changing conditions. What worked for the last 5 years might not work for the next 5. And third, you are speculating about future earnings rather than buying based on current value and safety. You are betting on a story about the future instead of buying a dollar for 50 cents today. So, if none of these strategies work, what does? Graham tells us. To enjoy a reasonable chance for continued better than average results, the investor must follow policies which are 1. Inherently sound and promising, and 2. Not popular on Wall Street. Graham is essentially saying, be contrarian, but be intelligently contrarian. Don't just do the opposite of what everyone else is doing. Do what makes logical sense but happens to be unpopular at the moment. This is why value investing works. Buying undervalued, profitable companies at reasonable prices is inherently sound, but it is often boring and unpopular compared to the excitement of chasing hot growth stocks. He also adds the following. Thus, it seems that any intelligent person with a good head for figures should have a veritable picnic on Wall Street, buttoning off other people's foolishness. So it seems, but somehow it doesn't work out that simply. Buying a neglected and therefore undervalued issue for profit generally proves a protracted and patience-trying experience. Graham is being brutally honest here. Value investing sounds easy in theory. Just buy undervalued stocks and wait for the market to recognize their true worth. But in practice, it's emotionally brutal. I learned this the hard way. I bought what I was convinced was an undervalued stock in the Greek stock market based on thorough analysis. For 5 years, it didn't move up. It actually fell further. I questioned my analysis constantly. I watched other stocks soar while mine sat there doing nothing. It took 5 full years before it finally started moving up and I made profit. Those years of patience were nerve-wracking. Every report, every market rally that left my stock behind, it all tested my conviction. This is why Graham emphasizes that even sound strategies require incredible patience and discipline. The market can stay irrational far longer than most people can stay patient. That's why most investors, even smart ones, abandon value investing before it pays off. They get tired of waiting and chase whatever is working right now. And that concludes chapter 1 of The Intelligent Investor. There is also a commentary from Jason Zweig at the end of this chapter. Here are the 3 most valuable insights from that section. An investor calculates what a stock is worth based on the value of its business. A speculator gambles that a stock will go up in price because somebody else will pay even more for it. This is the heart of the topic. An investor looks at what a business is actually worth. A speculator hopes someone will pay more tomorrow. When you buy a stock, ask yourself, am I buying this because I understand what the business is worth? Or am I buying it because I think the price will go up? Your honest answer will tell you whether you are investing or speculating. Later in the chapter he writes, as Graham never stops reminding us, stocks do well or poorly in the future because the businesses behind them do well or poorly. Nothing more and nothing less. This is so important. A stock is not a lottery ticket. There is a real business behind its stock. If that business grows its profits and becomes more valuable, the stock price will eventually follow. That's the beauty of value investing, its simplicity. Lastly, at the end of the chapter, we find this little diamond. For better or worse, the gambling instinct is part of human nature, so it is futile for most people even to try suppressing it. But you must confine and restrain it. That's the single best way to make sure you will never fool yourself into confusing speculation with investment. Gambling is part of human nature, so we don't have to suppress it, but we need to recognize it exists in all of us and confine and restrain it. This is incredibly liberating advice. Zweig isn't telling us to become emotionless robots. He's acknowledging we are human, and humans naturally want to gamble sometimes. The key is awareness and separation. When you feel that urge to chase a hot stock, recognize it for what it is, your gambling instinct, not your investor mindset. Keep your speculation separate from your serious investments, and you will never fool yourself into thinking gambling is investing. And that wraps up our breakdown of Chapter 1, the foundation of everything Graham teaches. You now understand the difference between investing and speculation, the three criteria every investment must meet, and why controlling your behavior matters more than predicting the market. In the next video, we will dive into Chapter 2, where Graham tackles one of the biggest threats to your wealth, inflation. We will explore how inflation slightly erodes your purchasing power and what Graham recommends to protect yourself against it. Click here to watch the video and don't forget to subscribe in order to be notified when the next video arrives. Thank you very much.